Over the last 15 months, a highly anticipated crypto project suffered a near-total collapse in the open market. This line chart tracks that decline. It launched at an all-time high of 7 cents in December 2024. Today, it trades for less than half a cent. That is a flat 99% drop, resulting in a prolonged bottom. Yet, looking past the catastrophic price action reveals a strange contradiction. The underlying asset here, Supra, actually possesses some of the most ambitious technology currently operating in decentralized finance. The industry validation is already there. The project successfully raised $42 million, pulling in direct backing from heavyweights like Coinbase Ventures and Animoca Brands. That leaves us with a difficult evaluation. Is this a dead asset slowly bleeding to zero, or a deeply mispriced opportunity in blockchain infrastructure? To figure that out, we need to understand what Supra actually built. It is a purpose-built Layer 1 blockchain with a very specific architectural identity. The network is designed entirely around the concept of AutoFi, or automatic DeFi. Standard networks rely heavily on external bots to run liquidations, execute trades, and trigger smart contracts. Supra completely removes those third parties, automating those actions natively inside the chain. Supra also has built-in oracles feeding real-world price data outward to over 90 other blockchains. By integrating the oracles and the execution directly into the Layer 1, the protocol eliminates network friction. It removes the reliance on external actors who might fail during times of high volatility. That vertically integrated technology stack is exactly what attracted the high-profile venture capital. The product itself solves a real mechanical issue in crypto. But great tech doesn't automatically equal a great investment. The tokenomics present an immense scale of incoming supply pressure. We have roughly 29 billion Supra tokens currently in the market, set against a maximum capacity boundary of 100 billion. That leaves an overhang of 71 billion unreleased tokens, a massive amount of future dilution waiting to hit the market. This creates an immediate trade-off. Buying into the token at its current $10 million market cap might seem cheap, but it requires accepting intense inflationary headwinds. Compounding that issue, the protocol currently lacks any token burn mechanism to counteract the continuous inflation. The development team does have a roadmap. The long-term plan is to gradually replace these inflationary token rewards with organic revenue generated directly by the native AutoFi system. The risk here is obvious. Generating enough native AutoFi revenue to offset billions of unlocking tokens is completely unproven at this scale. Anyone relying on that future revenue model is taking on heavy execution risk. You are essentially paying to wait and see if the team can deliver on their timeline. The brutal reality of these tokenomics means that early technological wins on the network could easily be erased by the sheer weight of continuous token unlocks. That supply pressure brings us to the current market reality, where the token anchors around 0.4 of a cent. Unsurprisingly, the asset is currently suppressed by overwhelming bearish sentiment. However, for high-risk momentum traders, that suppression creates an opportunity. Massive percentage gains become mathematically possible if the price simply reverts to its historical mean. Looking at this candlestick chart, we clearly see the critical psychological and technical resistance barrier, the 1 cent level. Breaking and holding above that barrier would act as a major bullish signal to the wider market, indicating a structural recovery. On the other hand, failing to breach 1 cent keeps the asset trapped. It guarantees a continued grinding downtrend. Short-term traders looking for a breakout have to understand their position. You are actively fighting overwhelming negative momentum in hopes of catching a sharp reversal. The current price action is a high-stakes standoff between historical data and the token's desperate need to reclaim single-digit relevance. This scorecard splits the project's data into clear green flags and red flags. The primary reasons to avoid Supra are structural. You are looking at immense supply dilution and a native revenue model that remains highly unproven. If you are a risk-averse individual looking for safe, reliable yield without heavy downside exposure, you should stay far away from this chart. The primary reason to consider the token is entirely based on the product. It offers a deeply discounted entry into a unique, vertically integrated technology stack that actually functions. The target persona here is the high-risk infrastructure speculator. This is for someone betting purely on the inevitability of automated DeFi. To make that bet, you must be willing to endure severe tokenomic inflation just to hold your position in the underlying tech. Ultimately, Supra is an extreme risk infrastructure play meant only for those willing to stomach severe, prolonged volatility. The final verdict: Supra's massive supply makes it a highly dangerous short-term hold, but its architecture makes it a fascinating foundational bet on a future where DeFi runs itself.